Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of the ultimate guide to divestitures, strategies, benefits, and real-world insights. Selling off parts of a business might seem counterintuitive, but it's often a smart move. Divestitures allow companies to streamline operations, focus on core strengths, and free up resources. Whether it's due to underperformance, strategic shifts, or market changes, divesting assets can play a key role in driving long-term growth. Understanding why and when to consider a divestiture is critical for making the right decisions. Definition of divestitures. A divestiture happens when a company sells, spins off, or separates part of its business. It's like pruning a tree, removing a branch to focus growth on the healthiest parts. Unlike simply selling an asset, divestitures involve strategic planning to improve a company's overall health and direction. They can reshape a business, free up cash, or pave the way for new opportunities. Now, let's dive into the types of divestitures and why companies pursue them. Types of divestitures. Not every divestiture looks the same. Companies have several methods to part ways with certain operations or assets. Here are the most common types. Sell-offs. This is the most straightforward route. A company sells part of its business, like a division or product line, to another entity. In return, it typically receives cash, which can strengthen the balance sheet or fund new initiatives. Spin-offs. In a spin-off, a company creates an entirely new entity by separating a division or unit. Existing shareholders usually receive stakes in the new company. This strategy allows both businesses to operate independently while focusing on their unique goals. Equity carve-outs. This involves selling a portion of a division or subsidiary through a public offering while retaining partial ownership. It's like renting out a room in your house. You still own the property but share some control and revenue with others. Each type serves a different purpose, giving companies the flexibility to address their unique challenges and objectives. Reasons for divestiture. Why would a company let go of part of its business? The reasons are as varied as the businesses themselves. Here are some of the most common motives. Financial restructuring. Sometimes, a company needs to repay debt or improve cash flow. Selling a non-core asset can provide an immediate influx of funds and solidify its financial position. Focus on core business. A jack-of-all-trades approach doesn't always work. Companies often divest to double down on their main strengths, shedding units that don't align with their primary mission. Regulatory pressures. Governments may require divestitures to prevent monopolies or resolve antitrust concerns. These mandates are designed to maintain healthy market competition. Underperformance. Not every business unit thrives. Selling a lagging division can cut losses and improve overall performance, like offloading a weight dragging a swimmer down. Whether it's a quest for simplicity, a need for cash, or legal obligations, divestitures are often about setting the stage for future success. The strategic role of divestitures. Divestitures aren't just about offloading assets, they're a carefully planned strategy to sharpen business focus and unlock value. Companies often see them as an opportunity to strengthen operations, financial performance, and future growth. Let's explore how divestitures drive these strategic goals. Improving operational efficiency. Carrying too many non-core assets is like juggling while wearing a backpack full of bricks. It slows you down. Divesting these assets allows companies to concentrate on what they do best. By reducing unnecessary distractions, leadership can direct resources to areas with the most potential for growth. Sharper focus. Divesting non-core divisions frees up management's time and energy. This clarity makes it easier to enhance the core business. Streamlined operations. By eliminating parts of the business that don't align with the company's primary mission, workflows become smoother, and inefficiencies are reduced. Resource reallocation. Teams, budgets, and technology can be reallocated to high-priority areas, improving productivity across the board. When a company no longer stretches itself thin, it operates more effectively, better serving its customers and stakeholders. Enhancing financial performance. Cash flow problems? Heavy debt? Divestitures are often a practical way to address financial pressures. Selling off underperforming or non-essential units puts money back on the balance sheet, providing much-needed liquidity. Debt reduction. Proceeds from a sale can be used to pay down loans or other liabilities, which boosts financial stability. Capital for investment. Divesting an asset generates funds that can be reinvested into growth opportunities or used to improve operational infrastructure. Profit margins. Letting go of low-margin or loss-making divisions can immediately increase overall profitability. Think of divestitures as a financial reset. They're a way for businesses to take a step back, clean house, and move forward in better shape. Fostering innovation and growth. Sometimes, you have to trim part of the business to make room for fresh ideas. Letting go of legacy operations or slow growth areas opens up room to explore new opportunities that align with the future direction of the company. Reinvesting in R&D. Companies can channel the proceeds from a divestiture into developing new products, services, or technologies. Expanding core strengths. Businesses often use divested funds to deepen their expertise in areas where they already lead. Unlocking agility. Without being tied to outdated or sluggish units, companies can pivot quickly, adapting to market demands or emerging trends. In short, divestitures aren't just about optimizing what exists, they're also about clearing the path for what's next. By focusing on their most promising areas, companies can not only stay competitive but also lead innovation in their industries. When done strategically, divestitures don't just let a company survive, they set it up to thrive. The divestiture process. Divestitures aren't just about selling assets, they require careful planning, precise execution, and a strategic approach. Each step in the process plays an important role in ensuring success. From evaluating the market landscape to meeting legal obligations, understanding the process is the key to a smooth transition. Preparation and planning. Every successful divestiture starts with thorough preparation. Think of it as laying the foundation for a sturdy structure. Without it, the entire process can crumble. Strategic planning and market analysis are non-negotiable. Here's why preparation matters. Market analysis. Researching the market gives you a sense of what buyers are looking for. Are there trends that make your asset more attractive? Understanding market dynamics helps position your asset at the right time and for the right audience. Defining objectives. Why are you divesting? Decide whether the goal is to raise cash, streamline operations, or focus on core strengths. Clear objectives guide every decision during the process. Stakeholder alignment. Ensure all internal stakeholders, executives, teams, and shareholders align on the purpose and expectations. Misalignment can lead to delays or even derail the process. Think of preparation as drawing a roadmap. Without clear directions, a divestiture risks getting lost along the way. Valuation and pricing strategies. How do you ensure you're getting the best deal for the asset? Accurate valuation and well-thought-out pricing strategies are critical. It's not just about slapping a price tag on your asset, it's about understanding its true worth. Asset valuation. Start by assessing the asset's financial performance, market position, and growth potential. Use methods like discounted cash flow, DCF, analysis, comparable sales, or asset-based valuation to determine its value. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.